Hi, Minerva India Under-served has been investing in institutionally under-owned and orphaned listed equities in India for nearly a decade and a half. Since spray painting industries, geographies, capitalizations is unfortunately commonplace in India, the strategy was designed to capitalize upon what we believe are often flawed and overly generalized narratives towards anything small. I would accentuate upon the word flawed here. Allow us to debunk some well-entrenched perceptions on this. Firstly, nothing leads corporate governance, or rather the lack of it, as a popular topic of interest. In our opinion, generalizing governance within a business simply based on size is preposterous. Several businesses that make, say, low-value chassis parts of a vehicle won't be large caps. Several media names can be large caps. Bizarrely, these and many others often get bracketed alongside everything else of similar size. Unitech, Ballarpur, Crumpton Greaves, Satyam, Jayaprakash Associates were all large cap names. While Nifty 50 components often end up being lemons, we haven't picked one in nearly a decade and a half, and our median market cap today is a bit north of a piddly $300 million. Second one, another common investor grievance, volatility. Small caps are too volatile, they say. Is that true? Of course it is. One shouldn't lose the context though. This grievance is really seeped in the premise that stock price volatility is somehow a reflection of volatility of the underlying cash flows of the business. In institutionalized markets, that is the case. In retail-driven markets, such as India, volatility is often a function of who's trading the stock and not necessarily a function of the underlying business. Take a top two holding, for instance. If we were to calculate risk-adjusted earnings growth for these names versus, say, their global, widely institutionally held peers, they come out comfortably ahead. If you do the same exercise, however, on stock price, the differential would be less wider. They beat on risk-adjusted stock price return too, but not by as much as they do on earnings. Third common gripe is skewness in returns within small cap strategies, somewhat suggesting that timing of entry and exits makes a large impact on long-term returns. Another narrative that is mostly true, but not always. If you were to remove the 4 best years for Indian small caps over the last 14 plus years since our inception, BSE small caps remaining return would be negative. You do the same exercise from Minerva and residual return would still be in double digits. Fourth, and certainly not the least, is the fear of permanent loss of capital. Internally, we run an exercise where we force ourselves to hold positions to perpetuity. The idea is to make us extremely skeptical while initiating exposures because there's no turning back in this exercise. You're locked in. This exercise therefore eliminates element of luck around exit timing. It also therefore makes the stock picker accountable for error in security selection. Basically, large cap emperors won't have clothes on at the end of this exercise. There's no hiding for anyone really. You might find it interesting that when we compare the results of this exercise between Nifty 50 components over the last 14 plus years and our stock picks, a higher percentage of Nifty 50 components lost capital versus our holdings. Bottom line is, do not generalize.